The other big one that we see a lot of is people are talking about how can I use my super to pay for my insurance, and the link between super and insurance is largely a historic one, and it goes back to when most retirement savings products were issued by insurance companies. So AMP, for example, that was a 100-odd year history of a company which provided life insurance and life insurance linked investment products. And so we've always had insurance and super together. And that's reflected today that in order to qualify as a My Super product and hence get default employer contributions, a super fund must offer a minimum level of insurance. And that insurance is usually available with an automatic acceptance level. So for potentially a quarter of the population who won't qualify for insurance in their own right, that is the only place that they can buy insurance. So if you suffer from a whole bunch of medical conditions or do a whole bunch of riskier occupations, your super fund may very well be the only place you can buy insurance. And that's a very tax-effective way of doing it. For those who do have the choice, the quality of product available outside the super fund arena gives you a much better outcome and maybe cheaper. And it also puts the control in your hands. So a insurance policy that comes with your super fund is what's known as a group policy. And that's a contract between the super fund and an insurer. And it's got whatever terms those two negotiate. And they go out to tender quite regularly. So the insurer will change potentially many times in your working life. And the consequence of that is that you may be able to get insurance today, but depending on what happens with the changing provider, you may or may not have the same level or quality of insurance. In fact, when Rest changed their insurer 7-8 years ago, perhaps, the condition of the new insurer was that you had to be at work on the day. So if you happen to be unemployed on the day the insurance provider changed, you suddenly found yourself without cover. So if you have the choice, it will generally be better to have your own contract. And so historically that might have been more expensive. The theory with group insurance is that if everyone gets it, then you get the sick with the healthy, and you get a better representation of the population, and so it's easier to predict the risk and therefore cheaper to insure. Whereas if only those who choose to buy it, you're more likely to get sicker people choosing to buy it, and so the risk goes up. So historically, non-super products were more expensive. That's becoming less and less true. And certainly if you are a white-collar professional in reasonably good health, you can get much better, cheaper cover outside of super. The other downside of having super provider products is you're sort of allowing the insurance tail to wag the super investment dog, that you are choosing an investment product based on the availability of insurance, and more importantly, being forced to keep it if you can't get alternative insurance. Whereas choosing to have your own cover and then using your super to pay for it gives you the best of both worlds, will give you better cover and give you the cash flow benefits of paying it through super. And that can create some tax benefits. So your super fund can claim a tax deduction for life insurance and TPD insurance that you couldn't if you bought it yourself, which makes it 15% cheaper, all other things being equal. Trauma insurance cannot be bought in your super fund, and so you always got to buy that out of your own money. Income protection sort of falls in the middle. Your super fund can get a tax deduction for it, as can you. There's little to choose between using your super fund and using your personal cash to pay for that. One advantage of having it in your super or using your super to pay for it is that it's easier to pay the premium annually, which can save you the equivalent of 1 to 2 months premium in a year. And it's sort of out of sight, out of mind. But generally, we find that most people choose a mixture of the two. And the tax treatment of the benefit is slightly different. So depending on whether you've got dependent kids or dependent spouse and how far through your working life are, the tax trade-off is slightly different. But your advisor can help you work that out. So generally, we find that most people pay for their life and TPD in their super fund, and about half the people use their super to pay for their income protection insurance.